In this episode, I answer one of the most common questions asked by clients practicing infinite banking. Should I focus on paying more premiums or focus on paying down policy loan balances? I'm Nate. I make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. All right, today I'm going to dive in and answer a question that's super common, as I mentioned in the intro. It's super common both from individuals who are obviously practicing the concept and they have policies with premiums that they're funding and they got policy loans outstanding and they're doing the thing, right? And also, but it has a whole bunch of usefulness, this answer, for those who aren't even practicing IBC yet. Maybe you're listening to this and you haven't practiced the concept, but you're learning about it. I think the answer to this question will answer many questions all at the same time. And it essentially has to do with something we've all been confronted with, is I have some money and I'm trying to figure out what should I do with this? And we've answered this question in different ways on the podcast already. In various different episodes. In fact, I'm going to refer back to some of those to answer this question. But essentially, the idea I think that needs to be stated at the very beginning is that policy loan repayment money and premiums are similar in some ways and very different in other ways. So if somebody was going to come to me and say, Nate, I've got some extra cash, I've got some policy loans, I'm funding policies, should I focus my energy on funding policy premiums and maxing those out and maybe even launching new policies with my capital? Or should I focus on repaying policy loans with this money? The answer is actually going to be based on some things that have to do with the policies in general. So I'm going to dive into this really quick and kind of get a few things out of the way. So the first thing I wanted to answer is, well, what's the difference, by the way? Like, what is the difference between policy loan repayments and premiums that you fund? What's the big difference? And the easiest way I find to look at this is that premiums always increase top line revenue. If you think about it like a business, a premium would be like doing something in your company to boost the revenue. So we're going to get better results by boosting revenue as opposed to maybe getting more profitability by reducing expenses. And that's actually the big difference between paying premiums and, making policy loan repayments. Policy loan repayments do not enhance the growth of the cash value. So that has to be understood by everyone getting started. Policy loan repayments are not magic. They don't like magically do something internally in the policy to produce better results as you make loan repayments than if you hadn't made loan repayments at all. Remember, policy cash value is guaranteed to grow and earn dividends based on the cash value itself, whether there's loans outstanding against the cash value or not. The loans themselves don't enhance the policy growth at all. The policy is going to grow whether you take loans or not. So the idea, first off, is that you have to understand the main difference between the two is that premiums boost revenue. They put new capital into the policy, and so every time you put a premium in, whether it's an existing policy you already own, whether it's the base premium, whether it's the paid-up additions rider, whether it's a brand new policy, anytime you take your capital and you send it in as a premium to a policy, base premium, paid-up addition rider, new policy, it's going to increase your cash value overall as a total banking system, and thus increase your interest and dividends being earned at the top line revenue. On the flip side, anytime you make a loan repayment, while it doesn't impact top line revenue, it does reduce expenses, you could say, if we continue the business analogy. And so essentially what that means is if I have a loan balance on a policy, I'm paying interest on that policy loan. So anytime, of course, I send in a loan repayment to pay back some of the loan, that means I'm going to be paying less interest on the loan. So essentially what stands before you, the big difference between the two, using funds to maximize loan repayments or using funds to maximize premiums, is really based on, do I want to end up with better results by reducing expenses, or do I want to end up with better results by increasing revenue, top line or bottom line focus? And so I think what this presents is essentially, I like to, or at least how it makes sense to me, is to see life in two different stages. And especially when it comes with banking, I kind of have a two-stage mentality. And the same thing, once again, I'm taking some things from the world of business as well. If a business is in growth mode, their primary focus is not reducing expenses. Their primary focus is on increasing revenue. Their growth mode, by definition, means we're trying to grow the company and produce more and more revenue. So the same thing I think applies to our banking businesses. If we are in the growth stage of life, which is typically what we would call the wealth building stages. Leading up to retirement, we are all in wealth building mode. We're trying to build wealth and accumulate bigger and bigger amounts of assets and positive cash flow and interest and dividends. And so in a growth stage of mentality, your main focus is going to be on funding premiums at a high level, because it's how you grow the bank. You boost the bank. In other words, if you started with a low premium and you borrowed some money and you just repaid and borrowed and repaid and borrowed and repaid, and you just focused all your attention on every time you have a loan balance throwing all of your money into repay it and borrow, and so you're always just sending money in as loan repayments with very little premium. At the end of the day, you're going to have a very small policy, because the cash value at the end of the line is based on the premiums that you paid, not on how many times you borrowed and repaid. That's just how you take out and replenish funds that are accumulating in the policy. So the idea is, if you're in the growth mode, loan repayments will be less of a priority, while premiums will be a higher priority. That doesn't mean it's not an either or thing, but we're talking about the priorities essentially before you. Is premiums are a higher priority when you're in growth mode. Things can shift for people as they enter the second stage of life, which can commonly be called as like the distribution stage of life. Or I've used the term consolidation stage of life. Whenever you see, your income based on maybe not working anymore going down in the future. And so instead of starting new policies and focusing tons of your capital in paid-up addition rider premiums and just maxing things out in the premium stage, as you get closer to the distribution phase of life, many times we'll make a change and we'll say, well, maybe at this point it's actually time to focus more of your energy on consolidating the loans down, reducing loan balances, stuffing money in as fast as you can, just to clean it up, consolidate things. You're 60, 65, 70 years old, and you're about to close down shop, and instead of focusing on starting brand new policies and maxing out premiums when you're carrying loan balances, maybe we'll focus on funding some of those loans back as a rule of thumb. So in the growth stage of life, loan balances are a lower priority than building capital into the bank and building the business, which can only be done through premium. As you get towards the tail end of your financial life, priorities may switch, where premiums may take a back seat and expansion and new policies may take a back seat to loan repayments. I wanted to make a caveat, though, as I mentioned, in this format, which is essentially, if you're in empire building mode, and empire builders are technically always in growth stage. So I'm just going to leave that with you. You can take with that what you may. But I've been talking about the path of retirement and the path of empire building as two different paths you can take yourself down financially. And I'm just merely saying that if you're kind of going down the empire building path, there's never going to be a distribution phase. There's never going to be a slowdown phase, because the goal of building an empire is that there's going to be an ever-increasing amount of wealth and cash flow, whether you're working or not. That's the idea of the empire building path, is to build a life you don't have to retire from, first off, and second off, that your assets and cash flow from those assets are going to keep on going up all the time, so you could even stop working, earning an active income, and still be building wealth, as opposed to the retirement path, which typically requires you to save up, store up, hope for the best, and retire and start liquidating accounts and distributing money, and hopefully you die before you run out of money. So that's why I don't love that path, and I'm of course, but I'm just merely saying, hey, empire builders are technically never really going to enter this distribution phase, or at least not the same way that we think of. But I wanted to make it be known, for if you're kind of going down, if you find yourself in the middle of both, you're not really going hardcore down the empire building path, which is what I'm hoping for people to go down, but you just kind of have a mingling of the empire and the retirement focus, that's fine. And, you have to decide for you what you want, how you want to live your life. And so with that being said, normally growth modes focus on premium. As you get closer to distribution phase, you may start consolidating your loans and having more of your cash flow focused on just paying those back. So I think that's very fundamentally important, but I wanted to get more specific as well. So to get more specific with answering this question in very detailed, like practical analysis of how to answer this question, the thing floating around that maybe you've even thought of is, well, where did the money come from? So whether you should focus on premiums and use this money to expand into new policies or max out policies or whatever it is versus repay policy loans, the question really should, honestly, before you make any decision, you should ask, well, where did this money come from? Where does money come from? And if you go back to episode 183, which you haven't watched, you should definitely watch. Episode 183, I talked about how to set up your life in a way that makes infinite banking, make a lot of practical sense. And I think you can do that with having 3 bank accounts. 3 accounts can help you manage the system and make a lot of sense. There's the expense account, the capital account, and the transfer account. And if you kind of live your life, if you're wanting to practice IBC at a high level, then having these 3 accounts can be very helpful. And the whole point of this was that the expense account is really where most of our financial transactions come into. So like normally it would just be your regular personal checking account that you live life out of. If you own a business, then of course you'd have like a personal expense account, and the business would have its own expense account. Could also have its own capital and transfer account too, by the way. But nonetheless, we'll deal with the individual. So the expense account is really where most of your income comes into and your expenses are paid out of. But the goal of that account is just to house enough money to pay for expenses. Remember, we don't want to leave a bunch of money in the banks. That's actually why we're doing infinite banking. You become your own banker and you build this banking business because you want to get out of the banks. So in the expense account, you only leave typically a couple months of operating expenses. So if you spend $10K a month, 10 grand a month, then you might have about $20,000 in that expense account at a max at any given moment in time. Anytime that account gets bigger than 20 grand in this little instance, you would start to transition that money into the capital account. And what that means is, all we're doing is we're trying to isolate what is our expense and lifestyle money. And then we're trying to isolate that from what is our capital, which is simply just money that's accumulating in your life because you live on less than you make, you're being successful financially, you have profitable investments. There's going to be capital accumulating. And that capital is really the pool of the reservoir that you'll use to pay premiums. And then the transfer account is the third account, and that's the account that you use to direct all of your policy loans. So whenever you receive a policy loan from an insurance company, it goes into the transfer account. And anytime that something occurs, in which case it would trigger a policy loan repayment, that money also goes into the transfer account. It doesn't go into the expense or capital accounts. And so I'm going to leave it at that for right now. To get a full synopsis of what I'm talking about, go back and watch episode 193 on YouTube primarily, because I'll be doing a screen share with it as well.
Are you tired of feeling like everyone has their hand in your pocket? At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to take back control by banking on yourself. Visit livingwealth.com/escapethebank. You'll receive instant access to what we call the Beginner's Course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even folks experienced with infinite banking often tell us they learned a ton too. So, it's worthwhile regardless of your experience level. Stop letting banks and Wall Street dictate your financial future. Again, that's livingwealth.com/escapethebank to gain access to the free course today. Now back to Nate and Holly.
So should I focus on, using my money to pay, expand the policies and do more premium into more policies, or should I focus on repaying policy loans? That goes back to, where did the money come from? And so I want to go through a practical example describing this, and we'll take in the 3-account methodology to help answer the question. So let's just pretend that you're doing infinite banking and you've got a few policy loans outstanding. So you've borrowed $100,000 out of your policy to make a real estate investment. You borrowed $50,000 from the policy to finance a car purchase, and maybe you borrowed $50,000 to pay for taxes in April because you got a big tax bill in April or something like that, and you use the policy to help pay for that. So we've got $100,000, 50 and 50, so we've got $200,000 of policy loan balances outstanding. And here we are, and I get a call from a client, and it's going to be like, "Hey Nate, I've got $100,000 sitting in the bank. I'm trying to figure out, should I just pay some policy loans back, or should I use that to expand and open new, focus on premium, open new policies maybe with it or something like that? Should I focus on growing the banking system?" And once again, the question that kind of at hand is, where did the money come from? So let me paint that picture. If you borrowed $100,000 to buy a real estate, rental property, or make an investment in some sort of cash flow producing, investment opportunity, the cash flow that that investment is producing is really what's being, according to our system, is what we will use to repay the policy loan balance. So if we have $100,000 out in an investment, the proceeds of that investment is what we're earmarking to pay back policy loan balances. The same thing could also be said for the car loan. So if I have a $50,000 car loan, I think I'm going to buy more cars than this one, right? I mean, unless you die early, the chances that the car you're in is the last one you'll ever drive is probably pretty slim. And so that's why I mentioned to people that if you're going to use your policy to buy cars, or if you're going to buy cars in general, you should actually create in your own mind, whether you have a budget or not, I don't even like that term, but whether you have like some sort of cash flow management concept in your own head, there should be like a car loan repayment should just be a part of your life, because you're just going to need to buy cars from now on. So whether you're borrowing money from a bank and paying them back, whether you're using your policy to fund a car and pay your policy back, or whether you're using cash to buy cars, you're going to have to pay yourself back to be able to buy another car. So nonetheless, you can't escape that. So what we're saying is the car loan should be getting paid just from your expense account. You should be paying your policy back from that expense account, just your lifestyle account, to pay back that policy loan. And then if you, the third loan was a $50,000 loan for taxes in April. Well, I'll ask the same question. Are you planning on paying taxes again next year? The answer is normally yes, barring some sort of prior income windfall or something like that. And so that my question to you is, do you think you should be repaying back that $50,000 policy loan balance that you used to pay taxes last year in order to have $50,000 again to pay taxes again this year? And the answer is typically yes. So most people, if they're going to borrow $50,000 to, let's say, pay for a tax bill, they'll likely be repaying that with their income. You got to be setting money aside to pay tax at some level. Might as well be building it back up in the policy coming out of your revenue. And so what this paints, by the way, is that we have a tax loan that's being repaid over the course of time with money we're setting aside to pay taxes again next year. We have a car loan that we're repaying with our expense account because it's an expense it's a lifestyle expense. So maybe we're paying back $1,000 a month on that car loan. So it's already got its repayment structure settled. And our $100,000 investment property is producing cash flow, and we're using that cash flow to repay the policy loan. So essentially what I'm trying to bring up is that all of those loans are already accounted for. We already have a systematic way to repay it. So if we chose to use the $100,000 of cash that we somehow have, by the way, where did it come from? We don't know yet in the hypothetical example. But that's what I'm trying to pinpoint. It's easy to figure out what to do with it when you know where it came from. So if it obviously didn't come from any of these policy loan reservoirs, and these policy loans that we have are actually being repaid by our natural, life plan, but across the board, all three of them, then it doesn't make sense to use this $100,000 to pay back the policy loan, because some additional ramifications will take place. So if we paid back $100,000 in policy loans, what are we going to do with the cash flow that we were setting aside to repay those policy loans to begin with? What are we going to do with that money? We can't put it back in as policy loan repayment. So in other words, if we paid back the rental property's $100,000 policy loan in our mentality, well, what are we going to do with the cash flow that rental property is producing? We can't put it back in as policy loans because we don't have the policy loan anymore. So what are we going to do? Well, we'll probably just use it to pay for premiums. So why did we use the $100,000 to pay back the policy loan when we could have just used the $100,000 to pay premiums and kept the existing setup? That's essentially the point. If there's cash flow that's coming in because you took policy loans, so if you made an investment or if you paid taxes or if you bought a car, there's already cash flow being focused to repay those. That cash flow should pay back policy loans. But if you have more money above and beyond that, that money shouldn't get convoluted in that mix. It should instead go to your capital account, not your transfer account, which is used for loans and loan repayments. It shouldn't go in your expense account because you're not planning on blowing $100,000 at the casino. So you move it to the capital account and use it to fund more policies. La-di-da. That's how you do it. And so the concept of, should I pay premiums with money or should I expand, with the capital I have, or should I just repay policy loans? Once again, it all depends on what is going on and where the money came from. So we can repaint this picture and say the same guy with $100,000 in a real estate loan, $50,000 for policy loan for taxes, and $50,000 for a car loan that he took out for himself. Let's say that he has $100,000, but he has that money because he sold the piece of property that he borrowed money to invest with. Well, if that was the case and he borrowed, and he sold the property, now he's sitting on $100,000, we shouldn't go use that money into the capital account to expand policy premium. We should just go ahead and use the 100 grand to pay back the policy loan that we used to buy the investment property. So, and to make it a little bit more useful to us, let's say he had bought an investment property for $100,000 and he sold it for $150,000. Really what we should do is take $100,000 and pay back the policy loan and take $50,000 and put it in our capital account, because congratulations. You made a successful investment that produced excess capital to you. You're $50,000 richer than before you started the investment. And so that should be, go into your capital account, and that $50,000 should be used to pay premiums. So the key question is essentially twofold. Number one, well, first off, which stage of life are you in? First off. So if you're nearing the distribution stage and you find yourself with a whole bunch of capital and you're about to, kind of wind down and retire, it wouldn't be the end of the world to use that money to pay policy loans. But if you are building wealth, especially if you're in empire building mode like I'm mentioning, then you should always be focused on premiums above loan repayments. You should repay loans with logical things, but you shouldn't take money that's essentially growth-oriented capital in your life and start using that just to replenish policy loans, or else you'll create some ramifications where you won't have any policy loans, you'll be maxing out premiums, and you'll still have excess cash flow, and you'll have to start new policies anyway. So there's no way around it. There's a logic to it all. So essentially, to recap, what's the difference between the two? Premiums always boost policy cash values. It increases your profits that you're making in the policies. It adds new cash value that didn't exist before you paid a premium. That's the case whether it's a base premium, a paid up addition rider premium, or starting a new policy with your capital. Using policy loan repayments doesn't change the policy internally. It doesn't make the policy grow faster. It doesn't add new capital to it, but it will reduce interest expense. So you can either grow through paying premiums, or you can make loan repayments and kind of reduce expenses. Either one's a very good tool. I mean, both of them are great. We'd love to make loan repayments. We love to. Anytime money goes into the policy, it's a great day. So the question really at hand is, well, which stage are you in? If you're in growth stage, if you're 30, 40, 50, even in your 60s, even into your 70s, if you're in the growth stage, you're still building wealth, you're still accumulating capital, you're still doing successful things, then you should focus more. You shouldn't take capital that's building up in your life and use it to pay back policy loans. You should continue to expand, get bigger and bigger and bigger banking systems going as you're in growth mode. If you find yourself kind of in the world where you're like, I don't think I really built the empire the way I wanted to, so I'm kind of going into the distribution stage of life, I'm going to consolidate down, then yeah, you could focus your capital on repaying policy loan balances that have accumulated. That'd be perfectly fine. And just kind of consolidate things down, make it very simple as you transition to a new way of life, a distribution, more typical retirement approach to life. And to get more specific, if you build your life, just like we mentioned in episode 183, where we talked about how the expense account, the capital account, the transfer account, and your policies should all be talking together and operating together, then this question will kind of go by the wayside. You'll always know what money should be used to pay premiums, what money should be used to pay policy loan repayments, because it'll just make sense to you whenever you build the system accordingly. And fundamentally, you'll ask the question whether I should pay a premium or whether I should make loan repayments. It'll be based on, well, where did the money come from? So I hope this was helpful. Very common question. So glad you spent the time with me. Once again, this has been Dollars and Nonsense. If you follow the herd, you will be slaughtered.
Listener, one last thing before you go. Start your journey towards financial security and wealth today. Visit livingwealth.com/escape the bank. Upon completing this course, you'll have all the information that you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/escape the bank.